This podcast is for financial professional use only and is not intended for use with the public. Material is for informational purposes only and is not intended to provide tax, legal, or investment advice. The opinions expressed in this podcast are those of the participants and do not necessarily reflect the views of Ash Brokerage. Welcome to Accumulation to Activation, the podcast that breathes life into your retirement planning strategies. If you're an advisor aiming to elevate your practice, deepen client relationships, and stay ahead of retirement income trends, we'll help you capture the opportunities on your doorstep and increase your impact. Each episode, we'll unpack the forces reshaping our industry, from the $44 trillion generational wealth transfer and the evolution of income planning to behavioral shifts, legislative updates, and breakthrough solutions that redefine financial security. Here are your hosts, Mike McLaughlin and Tim Ash.
Hello, everyone, and welcome back to Accumulation to Activation, where we talk about all things retirement income planning and all the retirement risk that surround and how do we increase the probability of positive outcomes for so many Americans. So thank you again, Tim, for taking time out of your busy schedule to join me. I know that we have a ton of good stuff to talk about today.
Yeah, we really do. Mike, it's always great being with you. And thanks again for the advisors that are tuning in and using this podcast to help them elevate their practice and hopefully walk away with some great insights to better serve clients.
Well, I think that we're going to give everybody some good tools to combat Fisher investments over the next several episodes. And again, I echo Tim's comments. Thank you for all of your production and your follows. If you do like the information here on this podcast, please like and subscribe. And also, as always, drop in your questions. If there's something that you would like Tim or I to talk about, drill into, we're more than happy to put that onto the agenda. So we certainly value everyone's participation and collaboration. So as I mentioned, over the next several episodes, we're going to break down a recent report that was developed by Fisher Investments called Annuity Insights, 9 questions every annuity investor should ask. And there's some good information, there's some poor information, and then there's just some omitted information as well. So let's just kind of jump in here. The first 2 questions are really super simple on this brochure about what type of annuity do I have and do I understand the contract. But Tim, well, first of all, I just want to say that I agree on this part of the brochure that every investor should understand what they're buying, how they're buying it, what the investment options are in there and break down. But it's so critical to involve a financial professional to be able to explain that, because even the industry has terrible language and then it's further diluted by legalese. And so that is the value of our position, to help Americans understand all of this type of stuff. But just kind of comment on maybe even the whole brochure as in general, but maybe the first couple questions, Tim.
No, certainly I would. I will say this. Fisher Investments does a fantastic job of advertising, marketing, and selling their services. They are everywhere. And how we came across this report was because my personal account, I must have been saying annuities too often into my Google phone. So now everything shows up in my feed in my email, and I kept getting hit from Fisher Investments. So I thought, my curiosity was piqued, and I wanted to understand what they were saying about annuities, because normally it's not very kind, it's not very polite, in my opinion, and the omissions that you talk about, I think. I don't agree with trying to scare people. It's like saying annuities are bad. Categorically, they are not. That'd be like saying bonds are bad, or stocks are bad, or ETFs are bad. But there are bad products in all of those categories. So Certainly the early questions that are asked in the report are pretty simple. Every contract holder should understand what they own. I would also say every contract owner should understand why they own it, because needs change. People may be in accumulation mode. And this is kind of akin to the name of our podcast, Accumulation to Activation. People's lives are going to evolve, right? You accumulate assets so that someday that you can activate those assets to spend them. And so, yeah, of course, you need to know what type of annuity you have, because there are so many different types. Variable annuities, which is really what this report kind of hammers on more so than anything else. And I don't disagree. There are some very expensive annuities that are out there, most of which that have withdrawal benefits. Then there are fixed indexed annuities. There are registered indexed linked annuities. There are multi-year guarantee annuities. There are SPIAs. There are DIAs. That's the sphere, right? Of the category. So saying annuities, you have all of these subcategories that you need to understand, and each product serves a different purpose. And so that's why you need to work with a professional advisor on how to navigate these products that are in the category of annuities. So of course we have to know that, and I just don't like fear mongering. To try to say, hey, these products are bad, when in fact there are so many that help people. And that's what we're trying to do here, is educate. Yeah, we do want to call out the bad actors, but we also want to talk about the products that help consumers live a successful retirement and enjoy it.
Yeah, you're spot on there. We spent a 2-day with a retirement income university, I think about 18 months ago, with a well-known income planning professional. He said exactly the same thing there. He challenged everyone. There are some bad annuities out there, and nobody can deny that. There's still some 14, 15-year surrender charges. That's just not good for most clients. But you can't make a broad-based statement that annuities are bad just because of a couple small bad players, because there are bad bonds, there's credit risk out there, there's all kinds of different stuff. That's where I think the value of everyone listening to this as a financial professional needs to understand that that's going to be their value over the next 20 to 25 years. And it's being that psychological warrior for our clients to help them disseminate what's good, what's bad, but most importantly, what's appropriate and what helps solve their income outcomes and increase the probability of success. Now, one thing that really frustrated me about this brochure, Tim, was that they continue to reference a 2004 FINRA alert. I mean, that's 22 years old now. And there have been so many different product changes in the last 2 decades, 2.5 decades, that FINRA alert is nearly obsolete. So to your point about fear mongering, I think that they throw this FINRA alert out here that just, it doesn't stand the test of time. Just for reference, our average surrender charge at Ash Brokerage is just under 6 years. In our when we include our financial institution spots, when we look at the entire breadth of all of the products that we sell, our average surrender charge is 6.2 years. So we just don't play in that space, but we get rolled up into it like that. So now I know that you're going to be passionate about this, Tim. This kind of struck my chord here, that there may be a more efficient, less restrictive way to reach your goals, meaning income goals. You've talked before, there is no other industry, there is no other product that can take longevity risk off the table. I don't care what you do, that is the insurance industry. Talk a little bit about the value of the insurance carrier managing money, taking that risk off the table, and being the only one able to do that.
Yeah, I am passionate. I am passionate about this, and here's why. The equity markets, bond markets can't use the G word, guarantee, right? You can't say this bond is guaranteed. You cannot say this equity is going to produce a guaranteed rate of return. Another thing those instruments do not have, and hey, these are instruments that I own equities, I own bonds, but I have a strategy in place to deal with my longevity. And that for my wife and myself, we have guaranteed lifetime income that we're going to get a check no matter if one of us lives to be 103. Now, that is something to me as a financial professional, just to say, what portion of your assets would you like to have last as long as you do? Most clients would probably say, well, I'd like all of them too if I could. But no, we just really want to isolate and talk about what is that baseline guaranteed income that you'd like to have no matter what happens. And to me, that is we have the only financial product that does that. And another thing, if you use say an immediate annuity, whether it's a deferred one or a single premium immediate annuity, they have mortality credits. So you get the benefit of using a pool of people. Some are going to not live as long, some are going to live very long, and the benefit of pooling mortality improves payout. And then there's also another thing: if you have non-qualified dollars, it's called an exclusion ratio. So it spreads out your basis over a period of time based on your life expectancy. So yes, I'm very passionate about that and how these products behave within a financial plan. We're not out here beating a drum saying put 100% of your assets into annuities. What we're saying is use the benefit of them. Insurance companies are the largest buyers of bonds. You don't have to, you can fact check me if you'd like. Look who the largest buyers of bonds are in the marketplace. And those bonds, you're transferring instead of you being the bond holder, the insurance company's managing that for you and taking that risk. So you're putting an insurance layer, so to speak, between the bond issuer and yourself. And I like that. And I want to have the companies that are buying the most bonds managing that for me versus me doing it myself. So I hope I didn't get off track there to your question, Mike, but would love to hear your feedback.
No, you hit a couple nails on the head there. First of all, the insurance industry is the single largest holder of bonds and probably the best managers of bonds overall. And what I think is super interesting is, and it's not just Fisher Investments, it's just about every comparison that I've seen, they don't factor in the mortality credits that you talked about. That is a substantial part of the total return of an immediate annuity. And you can't really say, hey, this is 2% or 3% of the payout, because we don't know how long you're going to be living. And but that is an important part of the insurance industry, the value that it brings, the pooling effect. And that pooling effect goes back to the beginning of time. Certain investments and derivatives, they aren't so long tested. They haven't been tested in up, down, sideways markets as much. And so for those people that want that guaranteed income, if you go back a couple episodes and listen to Steve Shankerman, I love his question about, tell me about your first job. Was it a salary? Was it commission, going out selling knives? How do you feel about that? And how much of that makeup do you want to be in your retirement income? And that's going to tell us how much equities and how much guaranteed income that you're really comfortable with. And we put our money where our mouth is, or specifically you put your money where your mouth is. We have a tool with JourneyGuide that can help define how much goes into an annuity. And it is clearly agnostic because it takes a look at your risk tolerance, your investment income and mix, and will help you define how much annuities really make sense in the portfolio to optimize it, to get the best rate of return, and to make sure that you don't outlive your money, and also pass along the most to your next generation. If you are not using JourneyGuide, I would encourage you to reach out to our sales team. It's a phenomenal tool to begin with, but if you're looking at something of validating the value of an annuity inside of a portfolio, there's no better tool, and there's no better tool to be on the same side as the table of a client. So I'll just pause there. I probably dumped a lot of information on you that you want to comment on as well there.
Well, I'll touch on JourneyGuide because it is a technology. It's not about how do I sell annuities. It's about what role do all investment products play in a successful retirement. Social Security, should I delay it? Should I start it early? It does look at income-based annuities. When should I turn them on? Should I even have them in my portfolio? What's my asset mix? So hey, it's a cakewalk to build accumulation. It's a cakewalk, and I don't mean to make. I hope no one's offended by that. What I mean is accumulation is a heck of a lot easier than decum because of sequence of returns. And you can look at the averages of what the market has done over periods of years. But if you sell into a down market, you don't have a chance to recover. And so another technique or another use of annuities is to create a buffer to that zigging and zagging that is going to go on in one's investment portfolio. It doesn't just start down here and just go straight up. There's some jagged cliffs along the way. And so what JourneyGuide does is it gives you a probability of success, and mathematically, it is the most sound technology that is out there to do that. Now, you can use JourneyGuide, and you may say, you know what, I'll never quote an annuity or look at an annuity ever. That's okay. That's fine. I don't agree with that technique. But if you want a retirement technology that shows your client how much they can safely spend with the probabilities that you want, it's the best technology out there. And you don't even have to put an annuity in it. But I encourage you to look at them because you'll be quite surprised at how much annuities are able to help certain portfolios.
I would say we all have an annuity in that calculation in the form of Social Security at the end of the day. And that's where I think I get frustrated. Everybody kind of is looking and hoping to use Social Security, and that's just nothing more than a government-owned annuity. We got a lot to unpack with this particular brochure, and we've always said that we want to keep this in the neighborhood of 15 to 20 minutes. And so we're going to continue going down the path of this Fisher investment to give you talking points when questions come up with your clients and things like that. So continue listening. Again, like and subscribe to this channel so that you can get the most up-to-date episode. So again, Tim, thank you for joining us, and advisors, thank you for listening and for the continued production and trust of our products and services.
Thank you, Mike. And again, thank you to the advisors that are tuning in. Please send us your questions, as Mike said earlier. We'll see you on the next episode.
This episode of Accumulation to Activation was produced by Ash Brokerage. For more on the most pressing and critical issues facing financial advisors today, be sure to subscribe, leave a review, and share this episode with a colleague. For more resources, visit us at ashbrokerage.com or reach out to our team at 800-589-3000. Let's start a strategic conversation. about how you can be more efficient with your retirement income and legacy planning solutions. Insurance product guarantees are subject to the claims-paying ability of the issuing insurer. Annuities are insurance contracts and may be subject to fees, surrender charges, caps, spreads, participation rates, and tax implications. Withdrawals are taxable and, if taken prior to age 59 and a half, may be subject to an additional tax. Product availability and features vary by state and carrier. Social Security and tax rules are complex and subject to change. Clients should consult their tax and Social Security advisors. Any modeling or Monte Carlo analysis referenced is based on stated assumptions and are illustrative only. Results vary by client profile, market conditions, and product selection. Past or modeled results are not guarantees of future outcomes.